Hi, everyone. So today we're going to get into our next section in our textbook, and this is going to be looking at the macroeconomy. And so far up to this point, we've really been looking over microeconomic tools and concepts such as understanding and estimating gains from trade and measuring and understanding how markets work. But the macroeconomy is the big picture. It's the sum of all our markets working together. What we're going to look at is how does a country, which is a combination, which includes a combination of markets, how does a country's economy look and how do we understand a country's economy? And to do that, what it really comes down to is how we measure it. And so in this section, we're going to look at the three different ways that we measure and consider and evaluate a country's economy. And so in chapter 10, we're going to be looking at measuring a nation's income. And this is going to be our how we approach evaluating the wealth a country generates in a given year. In chapter 11, we're going to be measuring the cost of living. And by cost of living, what we mean is we're talking about how much does it actually cost an individual to get by? Like how much money do they need to buy the things they need to their quality, what determines their quality of life. And in chapter 12, we're going to look at production and growth. And this is basically understanding why we want to know a nation's income, why we want to know their cost of living, and how can we improve those things. And that's chapter 12's production and growth. But for today, though, what we're really going to focus on is we're going to be looking at chapter 10, measuring a nation's income. And so when we started this course again, we kind of talked about some concepts that are microeconomics. And microeconomics really focuses on the study of households and firms, how they're making their decisions, and how they interact in markets. And so we were interested in, well, what is a company doing? Why is the company doing this? What determines how they decision? What are households' decisions? What are the challenges that households face? But when we switch to macroeconomics, what we're looking at is economy-wide phenomena. And what we're really interested in are concepts like inflation, which is a rising price level, unemployment, which is how many people have jobs and how many people don't, and economic growth, which is how much has the country produced since the previous year. Now, to wrap our minds around this, we're going to revisit an old model. We're going to revisit the circular flow diagram. And this is just a simple model for a macroeconomy. So if you remember this model from chapter 2, it was a useful model showing us that there's two agents, there's households and consumers, and they participate in two markets, goods and services, and factors of production. And then consumers buy goods and services that are sold by firms, and then firms buy factors of production, which are sold by households. It's a useful model because for macro, we now simply label the wages, rent, profit paid to land, labor, and capital and human capital as now GDP, i.e., domestic spending, which also happens to equal firms' revenues. Logically, that means there's two ways to calculate GDP, the income approach and the expenditure approach. Now, GDP, what we're going to be looking at, this is called the expenditure approach. And so just to switch, notice here how the circular flow diagram for us, we've only changed a few things. Now we have spending equals our GDP, equals the GDP as revenue to firms, and firms pay wages, rent, and profit, which equals GDP through the markets of the factors of production, and income, which equals the GDP to households. And so again, we see a lot of the same things, right? Like households, firms are buying and selling in goods and services and the market for factors of production. And again, the only difference is that our spending and our revenue is now equal to GDP instead of just a micro example for a specific market. So what is GDP? GDP is the gross domestic product, i.e., it's the market value of all final goods and services produced within a country in a given period of time. But let's break this down because we're not quite sure what this means, right? Like that's a lot of jargony words. Well, first off, let's think about market value. The GDP aggregates, adds up market prices for all final goods and services produced within a country in a given period of time. So the market value, what that's saying is that the GDP takes how much the price of Coca-Cola is, how much the price of coffee is, how much Coca-Cola and coffee are sold, and adds that together, and then adds it together with how many cars are sold and their prices, and keeps adding up all these things. And so that's the market value. Final goods, this means a good sold in completion, not as a material used to produce another good. So just to give you an example, Georgia Pacific is a company that makes paper, and they make two kinds of paper. For example, they make printer paper, which you buy from a store. That's a finished good. You buy paper from the store because you fully expect that, like, you're just going to print on the paper. That's it. That's the end. It has no further value. However, the printer paper purchased by a book publisher to print books, that's an intermediate good. Even though it's still paper, the paper is being used to create a new, more valuable product. And so the reason we don't calculate it into the GDP, we don't calculate intermediate goods, is because their prices are reflected in the final price of the final good. In this case, a book, right? So a book includes the cost of the author, it includes the cost of the ink, it includes the cost of the paper, it includes the cost of the binding. We don't add up all those things because all their prices are already reflected in the book. If we added up the paper again, that would be double counting. So goods and services, well, we have things like a good, such as paper, and services like a haircut. So that's simply a good is a physical material item that we can consume or use, and a service is a action provided by another economic actor that like creates value. So in the example of a haircut, right, you can't quote unquote take a haircut with you and use a haircut whenever. It is just an action performed by someone else that helps you. Advisory jobs, marketing, these are things that fall into services. Within a country, it's important to reflect the health of a country's economy more than its citizens' prosperity for the purposes of GDP calculation. Just an example, an American banker making bank in Tokyo offers little reflection of the health of the US. If they're making a ton of money in Tokyo, that tells you that Japan's doing well, but that doesn't necessarily tell you how the US itself is doing. Meanwhile, an immigrant worker in the United States, how much their income is a reflection of the health of the American economy. And for the period of time, this is typically a year. So we normally divide the number up into two things. We look at annual GDP, which looks at our economic change over a year, and quarterly GDP, which allows us to figure out trends in growth. So the components of the GDP. Now you might be saying, wow, this looks a little tricky. Like, what do we have going on here? Let me break this down. So simply put, our equation for GDP is as simple as this. It is Y equals GDP. So Y is our stand-in for GDP equals consumption plus investment plus government spending plus net exports. So this top equation, Y equals GDP equals consumption plus investment plus government spending plus net exports, that is simply put the equation for GDP. However, this equation breaks down. And what I mean by that is that each one of these variables is a sum of something else. So for example, consumption is the sum of goods plus services. So if I gave you the number for goods, so say goods was 500 and services was 700, then consumption equaled 1200, 500 plus 700. But goods breaks down further as well. We have different kinds of goods. We have durable goods and non-durable goods. Durable goods are actually a really good gauge of the economy because they tend to be more expensive and they're long-term purchases. A durable good is something you expect to last more than 5 years, maybe 8 years, 10 years. Cars are durable goods. Washing machines are durable goods. Tires are durable goods. Some laptops are durable goods. Non-durable goods are things we expect to be used up in quickly or in a fairly short term. So for example, food, bread, these are things that are absolutely non-durable goods. Produce, phones that we don't expect to keep or like we don't expect to work beyond 2 years. Like these are things that count as non-durable goods. And then services remain simply things like haircuts, marketing, etc., as we defined earlier. The I, investment. Investment kind of breaks down into two categories, not mentioned here, but let me just kind of draw this down. We have two sort of categories that go into investment. Houses are a form of investment, and capital spending. So houses and capital spending, these are forms of investment. So why is a house an investment, not a consumption, even though though a private household is buying it? Well, the reason why is because a household has a long-term value that lasts beyond its necessarily use, and its value grows. And so in many ways, we consider a house to be a form of investment spending. And then capital spending is basically buying bonds, buying markets, borrowing loans to invest in physical capital, to make and manufacture goods. Those are all aspects of investment. And this will become more important in later chapters. Now, government is this is just a breakdown of it's how much the federal government spends, F, plus how much state and local government spends. So these two added together, this equals government spending. And then finally, net exports is simply the difference between a country's exports and their imports. So exports minus imports gives you net exports. Now you might be wondering, why do we do this equation? Why is it exports minus imports? The easiest reason is simply this. When we export a good, what that means is that our country's income, remember that we're thinking of this as a spending approach. Remember that GDP is the sum of everything we've spent in a year. When we export, we get additional spending from abroad. So other countries are buying our goods. They're spending money on our goods. And so that adds to the spending on a country's goods. So in this case, America. Like when we export cars abroad, Americans are making money on those exports. And that increases our overall spending on American goods. However, imports are the exact opposite. When we buy goods from other countries, what's happening is we're spending money on their goods, and that wealth is leaving the country and going abroad. And so exports increase the wealth of our country, imports decrease the wealth of our country. And so we want to calculate those balances to see how much spending is remaining in the country or added to the country and how much is leaving. And so that's why net exports is additive to our GDP. Now, real quick, a computation of all this. This is just a simple example. Basically, if I gave you these numbers, this is the United States GDP in 2018. All it is notice that gross domestic product, Y, equals the sum of consumption plus investment plus government purchases minus net exports in this case. And the reason we have a minus net exports is because the United States actually runs a trade deficit. And what that means is we import more than we export. And so you can see the breakdown here of the percentage. And notice that consumption is our single biggest contributor to the size of the economy. This becomes a very important fact in later chapters. So GDP is a little more complicated than just numbering this up. We actually have two different kinds of GDP. We have the nominal GDP, and the nominal GDP is simply the numerical value of goods and services produced in a year, unadjusted for price fluctuations over time. So when you go to the movie theater and you buy a ticket for, say, $15, that is a nominal contributor to GDP. All you do is one ticket sold, $15, add that together, that goes into the nominal GDP. And that just value is the production of goods and services valued at current prices. However, that measurement is a little bit tricky, and it's actually not what we really want to know about. What we really want to know about is how many more movie tickets are we selling, or how many more cars are we making. And so real GDP, this is the important equation here. This is what we really are interested in, and this is the nominal GDP adjusted for price changes over time. So, for example, one of the reasons movies are always setting new records for the most sales is because inflation naturally pumps up the price. However, if we adjust for the price of a ticket and say, like, we just go back to 2005 when tickets were, say, $10, $8 a ticket instead of 12 or 15, it's easy to see that, oh, wow, like, yeah, sales would go up and set records just because the prices have gone up 30% since then. Now, this means the production of goods and services at constant values. So the way we do real GDP is instead of using the price paid for right now today, we pick what would the price of this item be in a good year, say 2005. So for example, if I go in and I buy a Coca-Cola today and I pay $2 or $1.88 for a Coca-Cola, in 2005, that same Coca-Cola might have been $1.25. And so we account for this inflation by picking a base here. And just to see how this works out is let's look at this table too. So notice that we have the years 2019, 2020, and 2021. Notice that the price of a hot dog changed from $1 to $2 to $3, and the quantity of hot dogs goes up from 100 to 150 to 200. And similarly, we have the price of hamburgers, and hamburgers go from $2 to $3 to $4, and the quantity of hamburgers increases from 50 to 150 to 150. So, without proceeding further here, just a couple of things we notice. One, the good is the same, right? A hot dog is a hot dog from 2019, 2020, and 2021. Similarly, a hamburger is a hamburger from 2019 to 2020 to 2021. Now, each year we have a growth in all three markets. So the number of hot dogs are growing in the amount we produce. We grow 50 from 100 to 2019 to 2020, and then we grow 50 again from 2020 to 2021. Similarly, hamburgers, we grow 50 from 2019 to 2020, and then we grow another 50 from 2020 to 2021. However, our prices are kind of all over the place. They're also growing and changing, even though the good remains. Maybe you're like, whoa, we're moving a little quickly here. Right. Let's pause down and break down what just happened. Why is this our GDP? Well, our GDP, right, is the sum of the market value of all the final goods. So in this example, hot dogs and hamburgers are our final goods, and how many are sold equals the quantity produced times their price, which in this case is $1 and $2. So our nominal GDP is simply $1 times 100 plus $2 times 50 equals 200. So since we only have two goods, we just have to sum up the price times the quantity produced. That gives us our nominal value. Now, if we go to 2020, following the nominal calculation, we're now doing $2 times 150 and $3 times 100. So what happens here? $2 times 150 plus $3 times 100 equals $600. Oh, wow, we increased 200%. We grew, actually 300%. We grew 3 times as much from 2019 to 2020, right? Did we really? Like, let's just pause. We only increased 50 here and we only increased 50 here. So obviously this increase in price alone is driving a lot of this increase in value. And we see that price increase driving a lot more value in the next year as well, because 3 times 200 plus $4 times 150 equals $1,200. So this is an insane amount of growth in this year if we just look at the nominal GDP. However, let's change this. Let's look at what happens if we go instead to calculating the real GDP. And the way we'd calculate the real GDP is we're going to pick a base year. So in this case, we pick a base year of 2020 or 2019. So 2019 is our base year. So what that means is we are going to take the price of 2019 and we're going to multiply it by the quantities of 2020 and 2021 to calculate their real GDP. So now it's going to be 1 times 150 and 2 times 100, and then it's going to be 1 times 200 and 2 times 150. And what do we get instead? Well, 2020, 1 times 150 plus 2 times 100. Now our real GDP is only 350. That's a lot less than 600, right? Like that's 200. Well, yeah, 250 less than 600. And similarly, in 2021, 1 times 200 plus 2 times 150 equals 500. So again, still significant growth. We're still growing quite a bit in the real value we produce, but the numbers are not as high and ridiculous as they were in the nominal GDP. So the real GDP helps us fight off inflation, and it gives us an accurate depiction of how much our growth actually is. Now, we can do one more little trick. And what that trick is we can calculate the GDP deflator. And what the GDP deflator is it is a relationship between the nominal GDP and the real GDP. And we're going to look on the slide at the formal definition of it. But what the GDP deflator shows us is how much is inflation distorting the nominal value from the real value of GDP. And the way you'll do this is it'll be the nominal GDP over the real GDP times 100. And so just to look at some practice examples here, in 2019, if we do the nominal, $200 over $200 real GDP times 100 equals 100. And you might be like, wow, that seems kind of pointless. But wait, why is 2019 uniquely this way? Well, 2019 is the base year, right? So because 2019 is the base year, that means we're multiplying its production by the same price as we did in the nominal GDP case. So 200 over 200 equals 1 times 100 equals 100. However, where we do see inflation take over is when we look at 2020 and 2021. When we set that nominal GDP over real GDP and multiply it by 100, we get a GDP deflator of 171 for 2020, and we get a GDP deflator of 240 for 2021. And so what that's telling us is that there is a ridiculous amount of inflation distorting the nominal value of our GDP. In this case, the inflation accounts for 2.4 times the number of the difference. Now, again, GDP deflator, this is just a measure of the price level as calculated as the ratio of nominal GDP to real GDP times 100. And the GDP deflator, again, just to see this right now, equals nominal GDP over real GDP times 100. And that's a metric that captures the inflation in the nominal GDP. And as we said, note in the base year, the deflator must be 100 because real GDP equals nominal GDP in the base year. Now, you might be wondering, is GDP a good metric? Like, is this really the way we want to measure the economy? It's certainly not perfect. It doesn't capture the health of a population. It doesn't capture their education level. It doesn't capture the work that stay-at-home parents do, the family economy of kids and parents working together, etc. It doesn't capture a lot of these things. However, GDP does trace really well with a host of things we are interested in. We're interested in how long people live, what their well-being is, what the inequality within the country is, and multiple other things. So what we find is that nations with large GDPs can afford to furnish the services to meet the goals we want. So richer countries can afford better education. And even though GDP doesn't tell us how healthy citizens are, we do know that wealthier countries and countries with higher GDPs can afford better health services to take care of their populations. And that, everyone, finishes our lecture on GDP. All right, next time we're going to talk about measuring the cost of living. Till then, take